Time for your business update. Singapore's growth outlook has turned more cautious amid an increasingly challenging global trade environment following US tariffs. That's according to the Monetary Authority of Singapore's report released on Monday. It says these tariffs act like a tax on Singapore exporters, squeezing their profits and forcing them to cut production. Analysts say small and medium enterprises in trade-focused sectors will need more help to manage cash flows. Nasyrah Rohim with more.
Slower growth, fewer job openings and weaker business confidence. That's how US tariffs are hitting Singapore's economy. Local exporters may have to tighten their belts to cope with the higher costs. With many of Singapore's trading partners facing the same challenges, this could slow down growth globally. In Singapore, MAS says it's trade-focused sectors that will be hit the hardest. It adds that manufacturing and wholesale trade could see slower employment as firms pull back on hiring and expansion plans. One analyst says that the small and medium enterprises will need more help to manage tight cash flows, while others may look to rely on free trade agreements.
Businesses here might tweak their strategy to reduce direct exports exposure to the US market, given that Singapore also faces the baseline 10% US tariff rate, but also seek other markets other than US, basically leveraging on Singapore's wide network of FTA to continue to grow their revenue and exports.
MAS notes that ongoing global uncertainties are also likely to further dampen the already moderating electronic cycle.
So I think one key thing to watch is Trump's ongoing consideration of US levies on semiconductors imports, which is adding a significant layer of uncertainty. And therefore, I think this poses a quite huge downside risk to the electronics sector if being implemented in the coming months.
For local business sectors like smaller food and beverage firms, MAS says they will continue to face pressures amid high labour costs and cautious buyers. This is even as the F&B industry is growing as it continues to reinvent itself. Such headwinds mean that Singapore's growth is expected to slow to 0 to 2% in 2025, down from the 4.4% in 2024. With slower growth, job demand and wage increases will ease, leading to less spending.